Hey everybody, this is Brent from Wolf on Wall Street Trade, soon to be moving over to the technicaltake.net. You still have a little bit of time to get in at 2008 prices. Subscribe at Wolf on Wall Street Trade before we move to technicaltake.net. So last weekend's video, what did I say? I said that I think we have some bear flags that are going to broaden out as we move through the week. So long as the consumer price index, CPI, and the producer price index, PPI, didn't come at big surprises on Wednesday and Thursday, and then we had this monstrously huge triple witching options expiration. I believe it was the largest September triple witching options expiration on record, and maybe I think the 6th or 7th largest ever, so really big. I'm going to show you what I told subscribers at Wolf on Wall Street Trade on Monday about where I thought prices were heading. So let me pull up a post from the subscriber website, and this is from Monday, September 11th, so the very start of the week, the day after I posted last weekend's video. If you want to pause the video, you can read it a little bit more closely. But here's the main takeaway. I said over here, hold on, let me change my pen color, sorry. Okay, so it wouldn't be surprising to see these bear flags that we're talking about, which have a modest upward slant, up to test the S&P 4500 support level, or former support level, back test of former support that broke the prior week. So when important levels like this break as support, more often than not, when they are back tested from below, they turn into resistance. So I would say that's the highest probability. This is Monday, and this is the actual chart from Monday, so you can see the level I'm talking about right here, 4500. So let's see what the week did. Actually, before we do that, let me cover the NASDAQ too. This was in the same post, so another bear flag broadening out. I'm guessing that a breakaway gap bearish highlighted in red here is probably going to act as resistance. It seems like a reasonable place for price to test to. The bottom of that gap, that is 15,500 for the NASDAQ 100. So let's take a look and see what happened. So here you can see the bear flag broadening out. This isn't a great example of a bear flag, to be honest with you. It's very big and it's retraced a lot, but the point is that it is bearish tone. Okay, so it's not like a real sharp bear flag, but in any case, look where we moved to by Thursday, just above that 4,500 level, and then coming into Friday, we gapped down below that 4,500 level. So obviously it's an important level. Former support over here, now acting as resistance, and as of Friday's close, look at this, we're breaking down below that bearish flag. So let's take a look at the NASDAQ 100. And remember from the post Monday, which was back here on the 11th, I said 15,500 is my target. So we hit that Thursday. And look, on Friday, we gap down and break down below that flag. So really ugly bearish price action on Friday. We'll take a closer look at those. So there's the gap down Friday morning. That's the bottom of that large bear flag. So just look at the tone of price. Falling, a little intraday bear flag right here, and then falling more into the close. Close just off the lows of the day, which is never a good sign when you close near session lows. Let's take a look at the S&P. So same kind of thing, came up to that 4,500 level. This is the top of the bear flag. This is the bottom. Here is Friday gapping down below that key 4,500 level. And again, price action, bearish, this little teeny like miniature intraday bear flag right at the bottom of the larger bear flag. And again, closing just off session lows. Not a good look for the market. Let's jump over and take a look at 3C charts real quick. Something always happens with 3C charts when we go into bear flags or bull flags. So this is the low right here that was the prior decline that starts our bear flag, which is over here. We almost always see a small positive 3C divergence starting that consolidation. And then usually the first day or two or so, 3C will confirm with price, which it did over here. But as we're getting up towards the top of that flag in the S&P 4500 target level, 3C is negatively diverging into that on Thursday and then gapping down hard on Friday. 3C is following it lower. You look at 3C over here, it's lower than it is over here, even though prices are around the same level. So this is actually a little bit uglier leading negative divergence where 3C is leading price lower. And if we look at QQQ on the same time frame, we'll see the same thing. So there's the positive divergence. This is after a pretty decent decline. This is our bear flag consolidation, positive divergence right at the low of the decline, the bottom of that. Here's the bear flag confirming, and then again, as we get to the top of the bear flag and the NASDAQ 100's price target level, look what 3C is doing, negatively diverging. That is selling into price strength, and then we come down over here on Friday. I showed this chart in last weekend's video. I have a lot of intraday price data. Each one of these is a day. That's why I love Stock Finder for 3C, because I have a long trend, but I'm starting to lose it over here. But I did show this last weekend. This is the top of the head and shoulders pattern right here, and this is a key reversal day. So 3C was negatively diverging in there. This is the neckline right here. So we get a positive divergence, a bounce off that neckline to form this right shoulder. 3C's negatively diverging, selling into that. And then this is this week, that smaller, about 6-7 day bear flag or so. Look what 3C's doing. It's leading lower. So this is an ugly price chart. This is really consistent with what I've been saying that I think we're getting in the major averages, which is topping formations. Before I go on with that, I do want to talk about crude oil. From Monday of last week, September 11th, I noticed that crude oil was trading in a bullish consolidation. So here's the post. Again, you can pause the video if you want to read it, but this is for subscribers at Wolf on Wall Street. So WTI crude oil futures, that is a bullish ascending triangle right there, which suggests oil can have another 8% leg up upon a breakout above this. That would be big trouble for the Fed's fight against inflation. I'll have some more information for you on that in just a second. Remember that Saudi Arabia and Russia extended their production cuts to the end of the year, which has sent crude prices higher. So this is not necessarily a whole demand thing. This is a supply thing. This is going to be troublesome with the Fed's fight against inflation. And there are whispers on Wall Street that the Fed, or the New York Fed's open markets desk, is intervening in oil futures, WTI crude oil futures, trying to bring price down. They're not doing a great job. I'll show you why. So here we're looking at WTI crude oil futures on a 15-minute chart. Here is that bullish ascending triangle that I wrote about and told members about on Monday. Said, look, it's got 8% of upside, and guess when it breaks out? The very next day, Tuesday. Boom, there it is, heading higher, 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 higher. So I have two measured moves for crude. One is around 7.5%. It's kind of the more conservative, and one is up to about 9%. We're at about 3.25% already to a 10-month high. A lot of times when you get a measured move that's that big, 8 to 9%, something like that, you'll get like a bull flag or some kind of bullish consolidation about the midway point. So we're nearing that with a 3.25% in gains. So around 4% gains. Start looking for a bullish consolidation. If you're in the mood, you want to trade crude long, that's a great area to get in on that consolidation. But what I do want to touch on is this week's major data. Okay, so like I said, if CPI and PPI weren't market moving, if they weren't like big surprises to the market, then the options expiration was going to be the point of gravity with that those price levels that I marked on Monday. In any case, so August retail sales, we also had retail sales, which was another big one. They were up 0.6% on the month for August. That's stronger than expected, but the gasoline station sales were up 5.2%. They had a huge impact on the overall increase in retail sales. So if we exclude the gasoline stations from retail sales, that 0.6% beat that was stronger than expected would have only been 0.2%. So retail sales came in strong because of gasoline station sales, because oil is heading higher, inflationary. The August PPI, that's the producer price index, came in line for core reading. I think, year over year increase of, I think it was 1.6% for total PPI and 2.2% for core PPI on a year over year basis. 80% of the rise in final demand for prices was attributed to a 2% jump in the index for final demand goods, which was driven by a 10.5 increase in prices for energy demand. So again, the only places that we're seeing surprises in these data points really are in higher gas prices, higher energy prices. So I want to pick back up with kind of the theme of what I've been talking about the last few weeks, actually months now, because I thought we were going to see the start of a topping process, distribution in June. We actually did see that, and as I always say, if you're a subscriber, you know this. If you listen enough to my videos, you hear me say it a lot. Tops are distribution, and they are almost always a process, not an event. So people think of bear markets in terms of crashes. Crashes are not bear markets. We can have a crash in a bear market or a crash that creates a bear market. But a bear market is generally a pretty dull, just trending down market, typically on lower volume. At some point, I do think we do get a crash in it because something's going to break, as always with the Fed. These topping patterns. So, like I said, in June, we started to see, about mid-June, distribution, selling into price strength in 3C. Apple was one of the first places I saw it. And again, while StockFinder has a lot of data and it helps me scale the charts, it helps me show you what was happening before, I'm running out of data here. But up until mid-June, what we were seeing was perfect 3C confirmation, which is bullish, right? We get into mid-June, you can see kind of the end of June over here. What do you see 3C doing? Negatively diverging right into this, and then prices breaking down. This is distribution, selling into price strength. That is one of the really valuable aspects of 3C, which is a proprietary indicator that I wrote years ago, and it has the ability to contradict price. So right here we're seeing it contradict price with a negative divergence. We get this bounce. This is kind of right shoulders for most of the averages or indices, right? And you know, if you look at where price is in this relative area and look at 3C, again, negatively diverging, selling into that price strength. If we look at a price chart of Apple, what you'll see is something very interesting called distribution starting in mid-June, right? And I'm going to bring up a pointer just to show you. This is June 12th, June 14th, 15th. This is the mid-June area. Look where price is now. So we started seeing distribution into price strength. So you could have sold right there and got out. You could have got maybe a little bit more, or people who chased it up here, they got hammered. They're at a loss. But we look at price, it is below those mid-June levels where we first started to see distribution. That is smart money, institutional money, the people that are not going to give you the information that I'm giving you, tell you the things I'm telling you. They do this under the radar. They want to sell to weak hands, right? So people who are buying Apple and thinking, oh my gosh, all-time new highs, we're heading there, they want you to think that because they are unloading their shares to you. That is distribution. If we look at the most important, most influential sector in the S&P 500, the technology sector, again, mid-June levels over in this area, price is below them, has not made much more progress. I mean, you know, if you really wanted to, you could have got 3.5%, 4% extra, but a lot of people just chase price like this and they end up at a loss of 6, 7, 8%. So we saw this distribution, and that is why we are seeing head and shoulder tops like this one in the technology sector. Let me show you some other head and shoulder tops that I'm seeing formed. And last weekend I went into the volume and all that stuff. So S&P 500, head and shoulders top. This was the bearish key reversal day, okay? Right at the top of the head, right there at 4,600. This is a bearish breakaway gap. We've rallied up, tried to test it twice, have not even come close to filling it, okay? So with an open bearish breakaway gap, that's even more bearish. We have something similar in the NASDAQ 100. Atop, it's just got a slanting neckline. Here's that bearish breakaway gap. Price moved into it, just started and was rejected there. So that is bearish, bearish, bearish. The Dow Jones Industrial Average, it's another one with a slanting neckline, little upward slanting, head and shoulders top there again. Dow Transports, they are the only of the major averages that has already broken down below the neckline right over here. I thought maybe we'd get a back test up to 15,500 this week. Not yet. Maybe we still get it, but that's kind of typical price action for what happens immediately after a neckline breaks, especially when you have all the other averages that aren't back down to that neckline or haven't broken down yet. So we still could see kind of like a back test up to 15,500 in transports, at which point I think it would be a pretty interesting short. And here's small cap IWM. Again, a complex head and shoulders top. It's complex because we have two left shoulders, we have a head, we kind of got one right shoulder. Really couldn't do anything over here on this second. It's been very weak. And our call in August of last year, 2022, was there's a change in character. We see a change in character. We're in a bear market then. In September, I'm like building the case saying, I think that this bear market is going to end and we're going to see bases in October. We got those bases in October, right? The Dow was the first one to put one in. And here it is right here, a little double bottom or W bottom that started this entire rally that we've been on ever since. Okay, the Dow performed the best the first month, then it's been the NASDAQ and the S&P since January. There's our head and shoulders top. But the point I was making was in August, we were still in a bear market rally over here, but there was a change in character, looking for a base in October right here. And my call was that I thought we would see more than a bear market rally, more than these, and bear market rallies are always really strong. But I also thought we would see an intermediate lateral trend, okay? So if we look at IWM small caps, best example of that. Change in character in August, bases forming, and here you can see we don't make a lower low. This is a bear market. We don't make a lower low. That changes the primary trend, the primary downtrend. Here is that lateral intermediate price trend going sideways. Getting back to our head and shoulders tops, again, the most influential sector in all of S&P sectors, technology sector, have a head and shoulders top over here. We have a bearish breakaway gap right there. Price has not been able to fill it. Came right up to it, met resistance there. So what I'm looking for next, whether it happens next week or in the next few weeks, doesn't matter, is prices coming back down to these necklines and completing all of these bearish head and shoulder tops. Semiconductors are part of the technology sector, but they are more economically sensitive. So if we look at the semis, I'm going to use the Philly Semiconductor Index. This is a complex head and shoulders top. We have two heads over here, multiple left shoulders, multiple right shoulders. There's the neckline. But I want to show you something else. Semiconductors tend to lead the technology sector because they're more economically sensitive. So this is a 15-minute chart of the technology sector, and in blue I've overlaid the Philly Semiconductor Index, SOX, and it's normalized, which means as of this point on the chart, the price percentage moves are normalized. You see the bear flag in the tech sector over here, and this is this last week, right? Towards the end of it. Look what's happening here. The semiconductors, towards this bear flag, we're already showing weakness, relative weakness. Over here, they're starting to lead the technology sector down. Where do I think that's going? Down to this neckline of the head and shoulders top in the tech sector. And we have these tops everywhere. It's not just a couple averages, a couple sectors. I mean, home builders. This is not the prettiest example of a head and shoulders top, but there's your left shoulder, there's your head, there's your right shoulder, there's your neckline, right? In home builders, speaking of which, something to share with you on home builders, real estate. So you've probably heard the whole narrative of higher for longer. The Fed's going to keep rates higher for longer, and if these oil prices don't get under control, gas prices don't get under control, yeah, they're going to be higher for longer. What does that mean? To me, that means we're going to have a worse bear market. We're probably going to have at some point in that bear market a worse crash. If you're just seeing this video, you should go back and look at some of my videos from a couple of months ago. I talked about the delayed effect of monetary policy, of Fed monetary policy. The Fed argues it's 16 to 24 months. I see, historically, and I'm, going very liberal with this, 12 months. So that means rate hikes from 12 months ago are just starting to be felt in the economy now. So you leave rates higher for longer, what does that do? That delayed effect of monetary policy hits the economy, hurts the economy more for longer. So this has been the biggest global tightening since Paul Volcker ran the Fed 40 years ago. If you think it's not going to leave a mark, whew. But the point I wanted to get to with the home builders, with real estate, all that, is the MBA mortgage applications. Here we're looking at the MBA mortgage market index for the United States, right? Mortgage applications are at 28-year lows. While we're not in a recession yet, like I said, it's the lagged effect of monetary policy that is the most important, and that's when it's going to creep up on a lot of people who are bullish right now. And believe me, I've been bullish since almost a year now, right? I just started seeing signs. I expected signs in June, started seeing signs in June. Now we're seeing topping patterns. The point I'm really getting to here is what I was saying a couple of months ago, is the lagged effect of those rate hikes when they went from 25 basis points, which was very moderate, to 50, to 75. Now we're in that period where those 75 basis point rate hikes are hitting the economy. They're starting to be felt in the economy. This is just one example of it. So back to the Head and Shoulders real quick. Last weekend I went over volume confirmation. If you didn't see that video, I'd encourage you to check it out, because a lot of people see price patterns like this and they say, well, it's a Head and Shoulders top. Or if they're bullish, sometimes they'll see Head and Shoulders bottoms. Look, they don't mean anything. The price pattern doesn't mean anything if volume doesn't confirm, and that is exceptionally important. And what I said last weekend is what happens over here on the left side doesn't really matter. Right here, this rally to form the head, volume should decline in a real true Head and Shoulders. On the decline to the neckline, volume should increase on the sell side. And as we move to the right side of this pattern, that gets more and more important. And what I showed last weekend, same thing. On this rally, volume declining, and then volume should pick up as we come down to the neckline. If we look at Dow Transports, what happened when they broke that neckline? There's the neckline, there's the break of it. What happened? They did it on heavier volume, which is exactly what we should see. So I'm going to show you something else, some breadth charts, market breadth, participation, as we move through these Head and Shoulders patterns that are nearly complete. So this is the approximate area of our neckline for the S&P 500. This white line is the percentage of all NYSE stocks that are trading above their 40-day moving average. Look how well they track with price, right? Until we get into this Head and Shoulders. The key reversal day specifically right at the top of the head, really ugly, nasty. Over here on the right side of the pattern, ugly, nasty. So it's not just this one. I could show you breadth charts all day long, same thing. Over here, again, the S&P 500 and the percentage of NYSE stocks trading one standard deviation above their 40-day moving average. Here's the top of the head. Look at the deterioration. Exactly what you should see. Things are pretty normal on the left side. You have no idea it's a Head and Shoulders at that point. It's just a rally. We have a rally to a higher high. You don't know it's a Head and Shoulders at that point. But then you start seeing stuff like this, right? Really ugly market breadth. This is exactly what we should be seeing in Head and Shoulders tops. So the next thing I think happens is we move back down to the neckline. We could have some bounces or consolidations. It doesn't matter. Moving back down to that neckline is the next major focal point of price action, right? So let me show you what actually happens when that neckline breaks and the measured move is met. I've done a couple of videos basically calling out financial media that has always got this thing, if you're 20% above a low, you're in a bull market. If you're 20% off the high, you're in a bear market. That's just hooey, all right? Everything has different beta. So a 20% move in Tesla could be a pullback, you know, it's not a bear market. What matters is the price trend. And what I'm showing you here is a 4-hour chart of the S&P 500. This is our Head and Shoulders top area. So what makes an uptrend is a series of higher highs and higher lows, all in these green circles. Here we get into the left shoulder, the top, the right shoulder. So we've already got the first failure to make a higher high at this red circle. Okay, we have a lower high. When that neckline breaks and meets the measured move target, which is a little bit below, well, depends on when the neckline breaks, but it's a little bit below 4,100. What do we have? We have the first lower high, the first lower low. This rally that is 11 months old now, this bull market rally, well, I'm not going to say bull market. So for me, a bull market is a primary uptrend. This is an intermediate uptrend. It's a bullish rally, no doubt, right? But the minute this makes a lower low, and it doesn't even have to come down to here. It could come down to 4,300, 4,250. This primary or this intermediate uptrend is over. Okay, that means the intermediate rally off last October's low, almost a year long, is over. And I'll just briefly touch on something I touched on last weekend too. We have these smaller head and shoulders. I call them smaller just because of what I'm going to show you next, but it's kind of like an exclamation point on the end of the rally. We're looking at now is a weekly chart of the S&P 500 off the 2009 lows, and we've got really a nice, secular bull market. We've had some, pretty decent drops. This was a 20% drop in October to December of 2018. Here's the COVID crash right over here. But we've had a pretty decent secular bull market. Let me take off these arrows real quick so you can see it now without any of my scribbling. But this is the 2021 high. This is where our small and this is why I call them small right now, head and shoulders are forming. Look at the price volatility in this area, okay, compared to this nice secular bull market. Same thing in NASDAQ 100. Probably go back even further. I think last weekend I went all the way back to the .com top back in 1999, 2000. But still, look, a secular bull market. We've had a lot of volatility, but it's nothing compared to this craziness going on over here. And this to me looks like a large double top that maybe ends this entire secular bull market that we've been in for almost 40 years. So let me wrap this up. Let's talk about Friday's price action real quick and heading into next week. Friday obviously was ugly if you remember. So here we are, 2-minute chart, S&P 500. This is Thursday. That's that 4,500 level I talked about. Gap down below it. Friday morning over here, bearish flag intraday. We moved down some more. Close right off market low. So this is not a good look at all going into next week. Same thing for the other averages, especially NASDAQ 100. Same thing, right? The exact level I talked about Monday for subscribers, 15,500 by Thursday. There we are. Here Friday we're gapping down. Bearish flag intraday. We close just barely off the lows of the day. So kind of pretty ugly price action heading into next week. Like I showed you just a moment ago, the semiconductors are starting to lead the technology sector lower. And towards the end of the week, well, actually right here in this bear flag, you can see the semis not performing well, leading lower. And then here at the end of the week on Friday, you can see the semis starting to lead lower. That's the neckline for the tech sector. Not good looking stuff. High yield credit is one of my favorite market-based leading indicators so long as you are aware of ex-dividend and you're aware that, if yields are up 10 basis points on the day, high yield credit's not going to be acting well. But high yield credit has a lot of institutional sponsorship. It's a very deep liquid product. They often use that, institutional traders, rather than S&P futures. And every time that we got up to the top of the bear flags over this last week, 6 days or so, high yield credit was the first to diverge. So here's that bear flag. Remember I showed you 3C positively diverging into the start of it. There's the bear flag. Here is high yield credit, right, in blue, that's overlaid, has totally different beta, so don't normalize this one. But like this is ex-dividend, right? So you have to be aware of that. It's not really leading price lower. It's gapping down because of ex-dividend. But the very next day, it is leading price lower. S&P is holding on here at 4,500. High yield credit is just declining. Pulls prices down into the bear flag over here. It leads prices in to the bear flag, leads prices higher by a day. Here's the top of the bear flag in price for the S&P 500. Look where high yield credit is on both days, so it's leading. Over here, it's pretty much in line with the break just below this bear flag. So it's not a really horribly ugly signal yet, but this is one we'll be watching very closely. And ultimately, what's happening right now is you're seeing market breadth get really ugly. That means a lot of stocks are not participating. the market's still being held up by the mega caps. That means a half a dozen stocks are holding up the entire market, but they have got a problem too. They've had a very strong inverse correlation with yields. I used this very same chart about a month ago or so to say, look, I think I even did a video on it. NASDAQ is not going to hold up very much longer. It is going to come off its highs. I'm going to show you that same chart the way it looks right now. Let me explain what you're looking at real quick. This is NASDAQ 100 futures in the red and green candlesticks, and in blue we have the 10-year Treasury futures. Remember that NASDAQ has had an inverse correlation, very strong inverse correlation with yields. Yields move opposite Treasury prices. So back here is when NASDAQ was kind of rallying over here and I was saying this is not going to hold because yields are dragging it lower. Drug it lower all the way over here, right? Got a little bounce in bonds, yields pulled back a little bit. This gives us those right shoulders and all that stuff, right? But what's happening again here is treasuries are lower, yields are higher. That is going to put pressure on those mega cap stocks, which are pretty much the only thing holding up the market at this point. So you get a lot more than this as a subscriber. Believe me, this is just like a review. You get this in the first post of the day or the first post of the cash market. In any case, have a great weekend. You still have time to subscribe at 2008 rates at Wolf on Wall Street Trade. And I'll put the link in the video description. Then we're going to be moving over to the new website, The Technical Take, with our own Discord room for our members. We have a lot of really diverse members. We have people who are new. We have people that are fund managers. We have day traders. And really good day traders. We have scalpers. We have just everything. It's going to be a fantastic room. But, you have a lot of other analysts out there that are doing these videos and they're saying, oh, look at this. This tells us the market's going to do it. They have a 6-month lag on the data they're using, on the indicators they're using. We're forecasting stuff in advance. If I don't know, I'll tell you I don't know. If I think it's a high probability, I'm going to tell you it's a high probability. But I am not going to use indicators and say, oh, look at this. 6 months later, it's telling us to get bullish. No, we were getting bullish in September of last year, a year ago, a month before the bottoms were put in. We were getting bearish or looking for things to start happening to build those tops at the end of Q2, June, right? Just like I showed you. So check out the website. Everybody have a fantastic weekend. I know there's only a day left. Members, subscribers, I will see you Monday and we'll have another great week. Thanks, everybody.